Greetings and welcome to LegalizeFreedom.com. I'm your host Greg Moffat, and today we'll be discussing the much misunderstood and sometimes mystifying science of economics, of money and its role in the current perilous state of the world economy, a dire situation which affects all of us. Our guest today is Alasdair Macleod, who has a background as a stockbroker, banker and economist. Alasdair runs financeandeconomics.org, a website dedicated to sound money and demystifying finance and economics. He is also a senior fellow at the Gold Money Foundation and publishes articles regularly at goldmoney.com. Hello and welcome, Alasdair, and thank you for joining us today on LegalizeFreedom.com.
It's my pleasure, Greg.
We're here today to discuss the state of the global economy, which is a rather big subject, but it's something that's basically constantly in the headlines at any given time, but certainly very much since the crash of '08. And starting point for me today is basically that as far as the mainstream media is concerned, that crash was very much something in the past. It's something that's happened, it's been and gone, and yes, there are still some ripple effects being felt, but basically it's a historical event. But as I see it, this is something that's ongoing. It's not over. The world economy basically blew up towards the end of '08, and the bits of rubble are still dropping out of the sky. I mean, how do you see it as over and done and dusted, or very much still affecting all of us?
Well, it's very far from done and dusted, and really what it was about, it was the whole of the sort of Keynesian paradigm, whereby you cheapen the cost of money, which leads to expanding bank credit, putting more money into the system. The build-up of debt on the back of that finally shuddered to a halt. And that is a very, very major event. And you're right, it's not just something that was in history and we just move on. No, because we're still dealing with the fallout from the end of really what amounts to, I suppose, nearly 100 years of expanding the quantity of money in the economy without it being fully backed by gold.
Well, sorry,
go on.
No, I was just going to say this is something that a lot of people don't understand, is that the sort of monetary paradigm that we have today, they kind of think that's been in place forever, but of course it's relatively recent, as you say, basically 100 years.
Yes. Well, I think most people, most historians of money would reckon that the founding of the Federal Reserve Board, the American Central Bank, marks the beginning of the modern era of paper money. America was on the gold standard certainly before the First World War, and then after the First World War, she resumed sound money. She actually jacked up interest rates at the time when the post-war depression hit America. I mean, can you imagine doing that now? Anyway, she jacked up interest rates, but the result of that was the reintroduction of sound money did something that the Keynesians just don't understand. It actually helped the economy sort itself out, and before very long it was recovering and back on track as per normal. So you had a recession, a very sharp recession, which, if you like, unwound all the distortions as a result of World War I. That recession in America lasted no more than about 2 years. And then, of course, we had the Roaring Twenties afterwards, which to a large degree was fueled by credit produced by the Federal Reserve Board. And that was the first time the Fed really started to stimulate the economy by producing extra money and encouraging banks to expand unbacked credit. So that was really the start, I think, of the modern monetary era. We started a bit earlier than that, insofar as Peel's Banking Act of 1844 legalized the Bank of England's paper money on the basis it was backed by gold. But it didn't tackle the problem of expanding bank credit. So you still had various credit-related crises, such as the overend Gurney crash in the 19th century. You had the Barings crisis in the 19th century. And these crises actually find their echo today. I mean, the Northern Rock situation was quite similar to the way the Bank of Glasgow went bust. It went bust because the wholesale markets wouldn't provide it with the credit to keep going, and that was an absolute dead ringer for Northern Rock. The Overend Gurney crisis was similar to what we have in America at the moment. Lots of banks going bust basically because the collateral that they've taken in respective loans itself has lost value and therefore left the bank exposed and insolvent. And then the Barings crisis was actually, I mean, that if I recall, was Argentina. And that was the Barings Bank extending loans towards one country in exactly the same way as banks around Europe have sovereign debt exposure, which is considerably greater than their equity. So, all these problems of expanding bank credit from the 19th century, we see happening time and time again. So there's nothing new in what's happening now, but we have unsound money, and the pile up of debt really culminating in that event, as you rightly described it, in 2008, and we're still dealing with the fallout. The fallout basically is that mountain of debt is trying hard in the private sector to contract, and as it contracts, banks. It's rather like the tide going out, it exposes the rocks, as it were. And the bank's balance sheets, when they start contracting, the fact that they're geared 10, 20 times the money they actually own in their shareholders' funds, as it were, means that they very rapidly start going insolvent. And that is, if you like, the central problem that we face in Europe and America, for that matter, at the moment.
Well, putting it in that historical context, then, as many commentators have commented, we could have seen this coming, and in fact, some people did see this coming. There were warnings about the situation coming from all over the place. I mean, I remember reading about people sort of saying that they, with the property market, for example, and the unsound loans that were being made to the, in the US, that was a situation that's been building up for a long time.
Indeed, I was very amused. You may recall the Queen opened or attended something at the London School of Economics, and this was just after the 2008 credit crunch. And she asked, well, you're all economists, why didn't anyone see it coming? Which I thought was a lovely... it put it in a nutshell, really. It's
a question that people who aren't economists are asking, sort of a Joe Public, as it were, is mystified by these sort of things. And of course, you switch on the mainstream media, and it's the same people in TV and radio studios across the world pontificating on the situation now and prescribing various remedies. And these are the people who didn't see it coming.
Well, yes, but I think there is a very good reason for this, Greg, and that is that everyone in the media, in the city, in government, they have studied the economics of Keynes. That is what they have been taught, and it's the economics of interventionism. That is the fundamental problem behind it all. The Austrian economists, those who follow the writings of von Mises and the various people before him and one or two afterwards, actually could see this coming. It's what von Mises called the ultimate crack-up boom. We're not actually at the crack-up boom stage yet, but we're moving there. And what von Mises meant by the crack-up boom is that if you expand credit, there comes a point where if you like, the value of the money starts going down and people actually have that final flight into goods. We're not there yet, but if we don't get off this course, there is no doubt that that is where we're going.
Oh, I mean, I've already said, I went in the post office the other day and the woman who was serving me had the gall to suggest that I might like to take a look at one of their ISAs. And I said to her, well, what rate of interest are you offering? And she told me, and I said, well, that's less than even the official rate of inflation that the government states, which is artificially low anyway. Yeah. And I said, I'd be better off just buying a few pallets of dried food, because I'm going to have to buy that in 6 months of the year anyway. That's going to protect my money. I'm going to lose money if I put it with you.